Well, good morning, I think, to everybody except people on the East Coast, which is Phil Williams, who's with me today, is East Coast. But everybody else here in the U.S., good morning and welcome to our webinar today. Very excited to be discussing this topic. The R&D tax credit. R&D tax credit is what we started our firm, Trimerit, as a sole provider of that. We've branched into other things over the years, but this has become a hot topic again because of some things going on with the IRS, some things going on with Congress, and just a lot of confusion on how you document, calculate everything about the R&D tax credit and 174 expenses. So we're going to dig into that today. Obviously, in an hour, we're going to do as much as we can, but we're not going to be able to go really deep on a lot of topics. There is one specific topic we're going to want to go a little bit deeper on, and I'll let you know when we get there. Before we even get to the housekeeping, just a quick introduction. My name is Randy Crabtree. I'm a CPA, been in public accounting for years. Do a lot of other things in the profession, a profession I love. And so I'm very fortunate that I get to give back in a lot of different ways. And with me today, as I mentioned earlier, is Phil Williams. Phil is a partner at Trimerit, Director of Operations. He is a dual degree. He has a degree in both engineering and a law degree, so he's a high-powered person here at Trimerit, and been doing this for quite a while. So, Phil, welcome to the webinar.
Glad to be here.
It's great. So some housekeeping before we get into it. I'm going to do the housekeeping over the About Trimerit slide, but some things to be aware of. This is available for CPE. We will have polling questions pop up during the presentation. We will announce those, but maybe not immediately as they pop up. So make sure you're paying attention. The polling questions are very, very simple. You should be able to get them all right. The question on all of them is, are you still here? So yes or no, either answer will be correct, and we will get credit for you still being here. Make sure you answer at least 3 of those 4 polling questions and stay logged on for at least 50 minutes to be qualified to read CPE. You will get your CPE certificate emailed to you fairly shortly. I know we've gotten the system down pretty quick, but I would guess it's within a day or 2. The slides are already uploaded. I think it's in the resources tab. We can put something in the chat if I'm wrong there, but the slides are updated there, but I think you will get an email, a copy of the slides as well. That's housekeeping there. Just a little bit about Trimerit. You know, we do credits and incentives. R&D is, again, that's a huge passion of both of ours. That's how we started this firm. We just had our 17-year anniversary, and R&D was the only thing we did for about the first, feels like, 8 to 10 years. And so it's a great credit. It's a great opportunity. There's just some things you need to be aware of these days with the credit and what's going on. One last thing before we move on to the R&D presentation is, many of you may have heard this, but we do host a conference as well called Bridging the Gap. I just want to let you know that the Bridging the Gap conference is open for registration. It has been for a while. The reason I'm bringing it up is 15 days from today, the early bird special goes away. The conference is July 22nd, 3rd, and 4th in Chicago, basically Rosemont, actually, just outside O'Hare Airport. It is, if you follow social media at all, it was the darling of conferences last year. People really loved it, and I was very happy about that. So if you want to get any more information on that, you can find it on our website at tri-america.com. But I wanted to let you know because that early bird special is going away in 15 more days. Just a little bragging rights there. We've grown pretty quickly the last few years, and that's because of all the people we work with from a partnership standpoint, so all the tax preparers and advisors. Okay, here's our agenda today. It's R&D. R&D twofold. R&D tax credit, and we're going to go into a few things with that. Documentation requirements is going to be a big part. Documentation is the new frontier of the R&D tax credit. Things have changed. Things have changed on the way we have to document it. Twofold. One, There's a new Form 6765 proposed, but we expect that to come out for this next filing season. So we are going to have new requirements on that, which Phil will go over today. And documentation requirements have changed based on some court cases. The last handful of years, IRS has been winning court cases. Prior to that, taxpayers were winning court cases. And based on these new IRS court case wins, the way we'd have to document the R&D tax credit has changed. So those are the things we're going to dig on with the credit. And then Section 174, we've been talking about this for a couple of years now. You all probably familiar with the law that kicked in beginning of the year 2022, but we got some clarification on 174 expenses this past fall. So we're going to dig into that a little deeper as well to give you some more information on that. Before I kick it over to Phil, I'm going to give a quick overview on the R&D tax credit, because Phil's going to then talk about documentation end of it and what's changed and why it's changed. But from an overview standpoint, let's just define the R&D tax credit so we're all on the same page before we go into what we need to do today. When we're thinking R&D, who are we thinking of? Who's the most common clients that you need to be, you as the tax advisor, you as the tax guru for your clients, you're out there, you're advising them. They're always looking for advice. They want you to be constantly thinking about them. Here's an opportunity for you to think about these clients with an R&D tax credit. And these clients are manufacturers. That's like number one. That is probably the largest user of the credit. But software developers are right there as well. And we've got some more guidance on what software development is in the 174 clarifications as well. So we'll dig into that a little bit today. Engineering firms are good candidates. Phil may touch on that a little bit when we talk maybe about retention of rates or risk, contractual risk. I may be putting words in his mouth, but we'll see where we go there. And then there's a four-part test, which I'm about to explain. If anybody can meet that and then also meet the documentation requirements, and if they could be candidates. So there's going to be more industries other than these three that I just mentioned. Historically, I'll list a bigger list, but I'm paring that back a little bit based on, making sure that we have proper documentation in place. And that's what we've always been about. Prior merit from day one has been about the documentation side of things, the credit. Just to give you a little history lesson. When we first started 17 years ago, the documentation requirements changed from a standpoint that we at least changed the way we documented the credit because of some things IRS were saying, some things they were doing. And basically, you wanted to tie expenses to activities. And that's kind of what's going on today, but at a higher level than we were even doing 17 years ago. So let's dive in then to what R&D is. So R&D tax credit is defined under IRS Code Section 41. We're going to talk a few code sections today. 41 defines the credit. 174 defines R&D expenses. We'll probably touch on 280C as well. So there'll be a few things we talk about today. But first one's Code Section 41. R&D tax credits. What are the minimum requirements to qualify? I'm actually going to start over on the right side, and then we're going to work to the left. I'm just reading backwards today. Try something new. So to qualify, you have to meet this four-part test. And I'm going to, hold on. Phil, can you mute? I'm hearing a lot of typing. Is that you? Sorry.
Yeah, sorry about that, Randy.
No, that's fine. Thanks. And I told Phil to unmute for the whole presentation. So that was my fault, not his fault. So to meet the four-part test, there's four things we have to look at to meet or qualify the minimum requirements. And first is, what do we have? What is this that we're working on? What is the IRS calls the business component? And so a business component is the thing we're working on. And they define this as a new or improved product, process, technique, formula, invention, or software. With the 174 clarifications, they go a little bit further and they talk about prototype and that, but that all falls within this. New or improved product or process is a good way to summarize it. But again, Code Section 41, new or improved product, process, technique, formula, invention, or software. So that's the component. That's what we want to be working on. We want to have something that's going to meet that first requirement. Secondly, there has to be technology involved with what we're doing. So there has to be some kind of science involved. We're talking, chemistry, biology, computer science, engineering, some kind of hard science. I mean, that's pretty much a no-brainer. Those first two are pretty easy to tell. Do we have a component? Although there's a little nuance to that. But also, is there technology? That's fairly straightforward. The next two are really the meat of it. And so when we're looking at that business component, we're looking at what we're doing. Are we trying to eliminate some kind of uncertainty? Is there uncertainty in this project? Are we having to figure out if we can do something better, faster, cheaper? It doesn't even have to be, are we trying to figure out if this is even possible? It can be process improvements. It can be product improvements, as long as there's significant development process in there. But uncertainty in the project is key. And then if we have uncertainty, that's the fourth part on the bottom left there, which we're going to do a process of experimentation. We're going to evaluate different alternatives to see if we can answer the question we have. Can we reduce the operations to manufacture this product? Can we make this product at all? Can we make this product using different materials than we have in the past for whatever reason? Can we, some kind of question we have uncertainty on that. Can we do this? We're going to experiment, which could be computer modeling, mathematical equations, evaluating different alternatives. It's basically going through different iterations of figuring out if we could do something. And just let you know, polling question number 1 is up. At least I saw it up. I don't see it now, but I assume it's up. So go to the polls. Make sure you answer polling question number 1. We want to make sure you get credit for this. I'm going to keep going through the polls. So that's your warning. Hopefully, is everybody there? I'm actually going to go take a look and see if we are answering those polls right now. All right. Well, hopefully you are. And then to continue on the overview, let's talk about what qualifies. There's an overriding factor that Phil will get into a little bit, probably on risk and retention of rights to the 4-part test. But when we're talking about a project that meets all these things, how do we quantify it? And it's important to know these because we're going to expand on these when we talk about 174 as well. So to quantify a Code Section 41 R&D tax credit, we look at 4 different buckets of expenses: salaries and wages, who in our companies, spending time designing, evaluating alternatives, conceptual idea, prototyping, who in our company is working on that. And then let's see how much time they spend on it and figure out, that percentage of wages or their wages specifically associated with that project. So salaries and wages, number 1. And salaries and wages, just so you know, very straightforward. Box 1 of your W-2. When we're talking 41 expenses, when we talk about 174 expenses, it's going to expand from there. But for 41, box 1 of your W-2, taxable wages. 2, are we outsourcing something that'll qualify? So do we have outsource, prototyping, design work, something? And this is probably something that Phil will touch on as well, because when we're outsourcing, we have to look to see who's taking on the risk of that project and who's retaining rights of that project. So are we outsourcing some of this information or some of this work? I'm going to go to number 4 first, rental of computer time. Just be aware of the R&D tax credit was written. This code section came into play in 1981, which to me feels like yesterday, but that's 43 years ago now. So 43 years ago, I was a freshman in college in a computer science, and we were using punch cards still. And so people were renting computer time back then. For the longest time, we did not have any rental of computer time when we were doing the R&D tax credit calculations. But the last handful of years with cloud computing services, AWS and those types of services, we are seeing clients use that, renting that, paying a monthly fee to that and they're using that in R&D projects. And therefore, we are seeing some of those costs come into play with the calculation of the credit. And then I go back to supplies. Supply costs are cost, they're defined as costs that are consumed in the R&D process. And so defining what's consumed can get a little bit, what is consumed, what is eaten up in the project, what's a capitalized cost, what's a cost of goods sold. Some of those terms got clarified a handful of years ago when there was a new IRS prototype rule that came out, the Code Section 174 prototype rule. And this prototype rule said that if we had uncertainty, the entire process of developing a prototype, then every cost that went into that was considered a 174 expense. Not necessarily a 41 expense, but a 174 expense. Could some of those have been then converted to a 41? Yeah, I think you can. I think there's some companies that went overboard with this and really tried to bring everything in from a supply cost standpoint into a giant new piece of machinery, and we're going to take every cost as a 174 and we're going to expense it, because we could expense 174 expenses when this came into play. Now we can't. Now we have to capitalize them. So just be aware that this new prototype rule, I say new. Honestly, this is probably, Phil, do you know? This might be 6 years ago now, at least. It might be even longer that these came into play.
Yeah, it was probably longer than 6.
Yeah. Yep. So, if 1981 feels like yesterday to me, 6 years ago literally feels like today still. And so these rules came into play. Just be aware of that. But traditional supply cost are materials consumed in the R&D process. And then and this is something that's going to change a little bit too when we talk about 174, or has changed. But if we meet all that, we meet the 4-part requirement, we have expenses, we document those expenses correctly, we take advantage of the credit, some estimate of what that expense could be, or that credit could be, is 6 to 10% of the expenses that went into that we're able to quantify into the credit. Be aware that the credit went through some changes again, in my mind, yesterday, but it wasn't yesterday. It was in the PATH Act, which I think came out in 15. I think it kicked in 2016, where we can use the credit to offset AMT for businesses that had average gross receipts of less than 50 million for the last 3 years. And another rule kicked in at the same time, that if we're a startup business, we have gross receipts of less than $5 million in the current year and no gross receipts further back than the last 5 years. Under the current rules, we can make an election to offset a portion of payroll taxes up to $500,000. When this was first defined in the PATH Act, it was $250,000. This went through an increase in the last year, or year or two, where now we can go up to $500,000. A $5 million company having a $500,000 credit is not going to be all that common, and so but that is the limit now. So that's just the quick. I say quick, I'm 18 minutes in. Quick overview of the R&D tax credit. Now, I'm going to hand it over to the one and only double-degreed partner at Tri-Merit, Phil Williams, who's going to talk about the new things going on, both IRS-driven and actually, maybe, I guess it's more IRS-driven. I was going to say congressional-driven too, but I'll probably touch on some of that. All right, Phil, all you.
Well, yeah, and to that point, it probably feels like Congress and the IRS and everyone else in Washington is ganging up on taxpayers when it comes to the R&D credit. It's been a flood of, we talk about positive vibes, it's been a flood of negative vibes for the past couple of years. But let's walk through where we're at, and let's make sure that everybody's getting into a good spot as we move out of tax season for tax season 2023, and talk about some of the things that we're expecting for tax season 2024. And also, Randy, just so you know, controlling the slides. I was chatting with Mark offline. We're getting a little bit of a lag. So
oh, really?
You look frozen to me right now. I'm still on the proposed Form 67 65 slide. So let me go through this. So back in September or October of 2021, the IRS Chief Counsel put out a memorandum that said, for all amended claims for the R&D credit, beginning a couple of months after that memo came out, they were going to need to have 5 additional items of information. So backtrack to that point. And in order to make an amended R&D credit claim, it was really simple. There's a 2-page form. There's a 6765. It could have had as few as 4 or 5 lines filled out explaining the quantity of the claim and the size that you're requesting as far as a refund. Didn't need any detail. After this was issued, the chief counsel said, in order for their team, the IRS's team in Ogden, to be able to do a desk level review of the claim, they need these 5 additional items. And all 5, in our opinion, were reasonable. But what was more challenging about that was that it did require that expenses be broken down by business component. So our approach, and I believe the approach of, if not everyone else in the industry, the vast majority of the other people in this industry, was to guide the studies around the final deliverable, around that final form. So it didn't require that individual business components have their expenses broken out. This did. And the other 5 items of information included breaking out specific employees, breaking out specific uncertainties, and what some companies even struggled with was a full identification of all business components. So I'll get into that a little bit more a couple of slides from now, but fast forward from the fall of 2021 until now, one of the things we said when that came out was, boy, I wonder if this is a prelude to the IRS requiring these 5 items on a timely file claim. We talked about it and we conspiracy theorized, and lo and behold, September 15th of 2023, the IRS issues a draft new Form 6765, and we go from being the very simplistic, high-level overview of what the credit claim consisted of to a much more detailed look, which is what we're looking at here. So on there, what they're asking for is, again, breakdown of expenses by business component, identification of what the business component is, identifying what uncertainty was uncovered or what uncertainty was resolved during that development. What was the process of experimentation? And then also breaking down the different categories. So when we saw this, and when other firms in this space saw this, there was a comment period that ran from September 15th through October 31st of 2023. And there's no way to verify this, but what I've heard is that there was over 30,000 comments that were submitted on these proposed changes because there were some things that were left unaddressed. They gave us a draft of the form, and for a handful of these questions, it said, see instructions. They never released the instructions that went along with form. So it was hard to see exactly what they were getting at with some of these. And really the biggest question in our mind was, you're giving us 10 blanks to fill in. Some of the companies we work with have thousands of individual business components. So how do we deal with that? And does this cause an overwhelming paperwork burden to the taxpayer, and really time burden to the taxpayer, to have to go through and do this? So I would imagine that many of the responses concentrated on that. I know there was mention of for smaller taxpayers, and I guess you had to fill in the blank on what a small taxpayer or what a small credit claim is. Would they still need to meet these requirements? If it's going to cost somebody $20,000 to come up with a $10,000 credit, that really doesn't align with congressional intent on putting this in place. So we're still waiting to see how the IRS deals with those comments. If anybody's dealt with the IRS over the course of the past 3 or 4 years, it's not the swiftest moving entity. And we're not getting a whole lot of news or information out of the IRS on this. So I'll go into it a little bit deeper in a minute. But we've really redesigned our process around this, not wanting our clients to end up in a tough spot come 2024. We actually implemented many of these changes for 2023 to get their record keeping in line and to get our process in line with what we're anticipating is going to be a requirement next year. So that's one of the big issues. We're still not 100% certain. We could be, Chicken Little running around saying that the sky is falling with this, but it's out there. And it's something we need to pay attention to, and we are positioned to address it. Randy, if you want to go ahead with one slide.
Yep, I will. But let's talk about this one question, though, first, Phil. So, as you said, this came out in September, and they were due by October 31st. And we've heard no update, is that right, on what they've done so far, how they've evaluated it. Other than, the rumor is 30,000 comments. Has there been any updates?
Other than loose. No updates. Actually checked this morning just to see on various forums if there was any talk, and there has not been.
Okay. All right. And then, so that was the one thing. So we knew, we had a good feeling this was coming. We actually had a good feeling this was coming even 2 years ago when we saw the amended, just like you said, we knew that was coming. Another thing that then has changed the way that we need to document is what's happened in the last handful of years with court cases. And so there's really two aspects to that. The first one being funded research. And so why don't you give us maybe a little timeline of what funded research is and how it was taxpayer friendly for a while and how it seems to have reversed now.
Yeah, for sure. So looking at the graphic that we have up here, looking at the timeline, you go back to the mid-90s. So, I mean, I bet Randy can even remember the mid-90s.
I can.
So you had some of these cases, Fairchild, Lockheed, they were cited quite a bit. They were relied upon quite
Phil,
a bit.
I'm going to stop you 1 second. I just want to announce poll number 2 is up. Poll number 2 is up. I want to make sure that anybody there that's trying to work and listen, make sure you get to the poll because you may not have seen that pop up. So get the poll. Go ahead, Phil. Lockheed.
Yeah, no problem. So again, you've had pieces of case law that have come out regarding funded research since the 90s. There may have even been some before that, but the ones we were relying upon came out back then. And then there was a long period of time where there wasn't not a whole lot of commentary on funded research. And it's addressed in the next slide, but you can keep it here, Randy. I'll just give a high-level overview. When we talk about funded research, it means when you're either paying someone to develop something for you or you're being paid to develop something for someone else. So when there's the exchange of funding, obviously from the name. So it was always assumed that the company, in order to claim an R&D credit on that type of work, you had to have economic risk in the project. So let's say you're company A, you're taxpayer A, and you're contracting with taxpayer B in order to develop a new widget. If you have a contract with taxpayer B and it says taxpayer B is going to develop that, there's going to be a guarantee, and for X amount of dollars, they're going to get that finished product completed for you, you don't have any economic risk. And then on the flip side, if you're the developer and you have an agreement with your client where you're going to provide services, let's say on an hourly basis, where you're just going to bill them for the time put in on the project, you're not guaranteeing anything, you're not warranting anything, you may not even have a final product deliverable that you're giving. Again, you don't have any economic risk in that. So in a lot of cases, it fell somewhere in the middle there. And that was when back in 2015, so a little bit more current, but still 2015, 9 years ago, with Dynetics and Geosyntec, that did start to be addressed more. And both of those address economic risk. They weren't, neither of them, in my opinion, was the most well-written case or piece of case precedent. But what we came away with in there was, again, using general terms, that if you were a contractor and you were performing services under a fixed fee agreement, and if you retained rights in what you were researching on, the right to reuse, or if the contract was silent about who had the right to reuse it, then it was not considered to be funded research. You were meeting both prongs of that test, and the R&D credit then belonged to that taxpayer. Pretty clean, not exactly spelled out as well as it could have been, but we had something to rely upon. Fast forward 5 more years, Populous Holdings came out. Populous Holdings was very, very taxpayer friendly. It was taxpayer friendly to the point where if you read through it, you get to the end and you're like, I don't know how the court even concluded that, because they kind of piled on things against the taxpayer until the very end. They're like, yeah, and you win. But you also had Meyer, Borg, and Johnson. Meyer, Borg, and Johnson was critical when it came to economic risk in the project, because it talked about having specific deliverables and specific measurables that you had to meet, as opposed to just engaging in a fixed price contract with your client. And for the record, Meyer, Borg, and Johnson, the appeal of that, I think it was the 7th Circuit, maybe the 8th Circuit, it did just come out with an appeal a couple of days ago, and they they maintained everything that was held at the trial court level. So that's another chink in the armor for anybody that is doing research that could be considered to be funded. Tangel v. Commissioner came out in 2021, and what that did, that really defined more clearly what retention of rights in a project meant. There were some IRS field service advices and NSARs that had come out previously that gave really good support, where they said things like, unless every element of rights has been conveyed to another taxpayer, then you still have substantial rights in the project. It almost seemed too good to be true, but it was something that we could rely upon, and it was something that was working. Tangel kind of shut that down. And then after 2021, this is when, again, not to take the chicken little approach, but things got really bad for taxpayers with Proficient, with Grigsby, and with Betts. Again, just continuing to layer onto that Meyer-Borgman-Johnson decision and more clearly state what economic risk is and what people need to prove in this setting. So again, this has been kind of that slow burn and until 2021 when the case law started piling on. So we want to be careful with this because it's something that the IRS is focusing on. There needs to be a detailed review of contracts. Randy, if you want to skip ahead one slide. Again, this goes through the funded research definition, but we need to make sure that those two last bullets are what are being addressed. And we're looking to make sure that economic risk has been met, and we're looking to make sure that rights have been retained in the project. If so, no big deal. We're back to that same test that Randy described of making sure that the four steps to Section 41 have been followed. If not, this can be a little bit of a problem. So funded research has been more complicated. Again, nothing that we can't work through, but we need to keep a close eye on it.
So it's just a matter of evaluating the contracts that the taxpayer and the provider to that taxpayer have. Is that the key?
Matter of reviewing contracts, statements of work, purchase orders, master service agreements. I mean, it does need to be a thorough dive through all of that.
Okay, and we want to make sure then that the taxpayer has the rights retains the rights and takes on the risk for that taxpayer to take the credit, correct?
Yeah, and you've even seen one of the specifics I'll give, and this is for engineering firms. It used to be that the federal government didn't really care about retaining rights in work product. But as of late, I've seen over the course of the past 2 years, there's been certain administrations that have been baking that language in. So even working with the government on some of these projects, they're starting to make it more clear that those rights have not been conveyed. And again, it shifts the qualification away from the researcher. Now, even bigger than the funded research issues, which have been big, the qualification and the calculation issues have been big as well. So similar timeline, go back to the mid-90s. We had the Food v. Commissioner case came out, and it was a big case precedent. The funny thing is, Food v. Commissioner was all over. I think it was a $2,500 refund claim. Not a huge sum of money by any means, but it gave us something to rely upon. And what we could rely upon was the utilization of supportable estimates in calculating qualified research expenses. Food kind of backed up, I think it was a 1918 decision of Cohen v. Commissioner, which had become a little bit dated because it talked about traveling on trains and by horseback and some of those things, which was a little bit harder to argue with a straight face. But Food reaffirmed that, and again, was something that could be relied upon. McFerrin, 13 years later, further amplified a lot of what was said in Food. And it wasn't across the board. There were a couple of negative pieces of McFerrin. Trinity, that goes to the supply costs that Randy was talking about in the inclusion of first article or prototype expenses. Again, very positive. Souter v. Commissioner, I saw somebody refer to this case as the R&D Swiss Army knife. When it came out, it could not have been more taxpayer favorable. It came out and the tax court affirmed the utilization of estimates. They came out, they affirmed the inclusion of C-suite employees, so long as they were directly involved in the performance of research. Very, very taxpayer positive. The only thing that was negative was they did better define what reasonable compensation was for the president, and he had taken something like I forget what it was, like a $10 million W-2 wage, and they said, well, that really is not a reasonable wage for the president of this company. You're receiving that because you're also the owner of the company. So that was a negative part of that one, but a lot of really positive things to pull out of that. And Suitor was relied upon at audit for probably 5 or 6 years, where it was almost like a get out of jail free card. Then we got to Seymour Milling in 2019, and that was where, again, if you were to talk to me offline and say, hey, should some of these cases have been brought? Should some of these cases have been appealed? I could share all of my conspiracy theories with you, but too many if you don't have that conversation. Anyway, with Seymour Milling, that dealt with specificity of technical uncertainty and specificity as to business component and specificity as to process of experimentation, where the court said you can't make these broad and you can't make these conclusory statements. Like Seymour Milling never knew the proper way to they were processing grain. They never knew the proper way to process grain, and they had no way of knowing that until the entire batch had been run through. And the court said, we need to get more specific than that. We can't make those broad claims, which again didn't seem unreasonable, but at the same time was a chink in the armor that Suitor had developed. Then you get to Little Sandy Coal. Little Sandy Coal is where everything goes off the rails, because Little Sandy Coal essentially throws out the broad usage of estimates in calculating the R&D credit, which I would have to imagine that there were quite a few claims that relied upon that and reasonably relied upon that. So Little Sandy Coal got into specificity of business component. Little Sandy Coal got into qualification of a business component only if substantially all the activities, and that can be based on an hourly or cost basis, 80% of those activities were within the process of experimentation. So there was the trial court verdict that came out in 2021, the district court, and that made a couple of statements. One of which was that they were saying that any of the time that was claimed or that corresponded to a QRE for the direct support or direct supervision of research was not experimental. And that in and of itself could throw some of these claims out of whack. The Little Sandy Coal case was, for the most part, affirmed with the Seventh Circuit in 2023. They did throw out the portion about direct supervision and direct support not being experimental. They said, yes, you need to look at what those activities are in order to determine whether they're experimental or not. But that's the big thing. And actually, that's the big question at audit now that we're facing is, how did you determine for this business component that 80% of the expenses were experimental, and show us your math? And the tough thing with that is that for claims that were made prior to 2021, you've got to go back through and do your best to estimate it, but the math may not be there. The math wasn't even considered prior to that. So that's been a little bit of a problem. You layer on the Moore v. Commissioner case, which really shot down the inclusion of qualified research expenses for upper level executives. Again, just not being able to say that the president of a company or the COO or CTO of a company, spent substantially all of their time supervising research. It has to be more, it has to be better documented, and there has to be more behind it than that. So again, all of this came together along with the form changes, and it really said, hey, this is what the IRS is pushing us towards. The IRS doesn't like this credit. The IRS doesn't like the way that it's being approached. We need to change the game up a little bit. So Randy, if you want to skip ahead one.
Yeah, can I ask one question before we do that? So when you're talking about the substantial rule, substantially all, 80% of the expenses associated with this have to be associated with the process of experimentation, if I'm saying that right. Mm-hmm. Is there, because in the past we've talked about a shrinkback rule. Are we able to stop that at some point and say, okay, we're at 80% at this point, and then we stop here, and then we're not going to take the credit on the rest of these expenses? Is that still possible, or is it start to finish?
So good question, and I should have covered that. So close to what you said, the shrinking back doesn't necessarily refer to a time period, but it refers to discrete business components. And the example, actually, what was being discussed in the Little Sandy Coal case was basically the inclusion of all the expenses that went into building a 600-foot ship. And I don't remember what the ship was for, but the court said, yeah, the expenses that went into some of these, like we bet the propulsion system had a bunch of qualified expenses tied to it. We vetted the design of the hull, and they toss out a couple of other examples that I can't think of, but portions of the ship they agreed with. And that's a shrinking back that you're referring to, where they could have said, yep, our designers, our engineers, our fabricators had to do this, this, and this. The argument that they were trying to make in the case was that there was no way to validate that the ship was going to operate as designed, and I'm paraphrasing by saying this, but that there was no way to verify that the ship was going to operate as designed until you got the whole thing put together and put it in the water and saw whether or not it floated.
Okay, so if they would have argued something different, maybe they would have at least one part of that. Okay.
Yeah, the court even acknowledges that, hey, if you had said this, and if you've been able to show expenses for those other discrete business components, yeah, absolutely. I think that there probably is research going on here. You have not provided us with enough in order to determine what that reality is.
Okay, and so that gets to the individual business components that we need to go to, and that the documentation requirements now on that, and then now the study process changes that you'll go over here. So I'll let you jump into old way and new way.
Yeah. So old way, new way. Old way was. Many taxpayers would probably say, hey, the old way was great. And it was great because it was simple. It was a lot less work on them. It was a lot less work for us in order to come up with defensible credit values. Just the utilization of estimates made things easier. You're not having to necessarily go through and say, we've got projects 1 through 100 and employee A spent 10 hours on project 4. I mean, that's where it starts getting more difficult. And that's really where I kind of alluded to this in an answer in the chat, but that's where setting up some information tracking and setting up some expense tracking and setting up some of the accounting functions within a company early on can make that simpler, as opposed to trying to go back and revisit things later on. But the top-down approach, like it says here, it was based on the org chart. Okay, we've got 20 people in the company, 4 of them are engineers. Those engineers spend the vast majority of their time developing new products. We're going to say they have 75% allocations, and then you have your quality director that spent 25% of their time developing the quality plans, and you had the engineering manager who spent all of their time supervising these people. The math would come together pretty simply, and this was, Randy, if you want to go ahead one more slide.
Yep. And I'm going to ask a question while we do that, because a question popped up, and this question was someone's asking about the 174 legislation, and has this affected that anyway? But the real question was, if the legislation does not revert back to pre-22 law, do you expect these cases to start to go the other way, i.e., the IRS says more costs are 174 slash subject to the credit? I don't think that's going to affect how they're doing their audits at this point.
Yeah, I would probably, I would say the same thing.
Yep.
And I've actually seen in practice a couple of opportunities where the IRS, at least at the exam level, could have said, hey, all these qualify under 174 and none of them qualify under 41. And it doesn't seem to be the approach that they're taking.
Okay.
But if anybody wants to join me in a tinfoil hat conversation, I'll be available later. We can talk about
that. I can confirm he will do that.
All right. So top-down approach. Again, it was supported by case law, and that Souter case was very, very, very helpful when it came to putting together those claims. And then, in this world, you get validation on something when you take a client through audit, and exam says, yep, no changes in this. And we had time after time after time where that was the case. Seymour Milling kind of started the shift, and then Little Sandy Cole put it over the edge. So while that was the old way, here's the new way. So bottom-up approach. And bottom-up approach means starting with the project, starting with the business components, and digging through with the client, going hand in hand with our clients and saying, how can we, identify the list of business components that are going to meet that experimentation requirement? And then second off, how can we go through those business components and come up with a way of measuring expenses that the IRS will agree with? So it doesn't talk about it here, but there was a RevProc put out back in 2011, that talked about the utilization of statistical sampling in determining expenses. So we built a new approach around a bottom-up methodology utilizing what was said in that RevProc. And because you do have to utilize that calculation mentioned in Little Sandy Cole to prove 80% qualification. It's a method where we could do that as well. So skip ahead one more slide, Randy.
Yeah, and you may be saying this on the next slide, but not only do we have to then figure out the expenses associated that qualify, we have to figure out the expenses associated that don't qualify to see if we meet that 80% substantially all rule, correct?
Exactly. Yeah. No, it's trying to get a holistic view of the project. And oftentimes in that holistic view of the process of the project, you're going to have 4 people. Again, this is just hyperbole, but you're going to have 4 people that are heavily involved in the design of a product. It'd be well within that experimental function. You might have a person or 2 that have a project management function, or you might have a person or 2 that are, providing direct support to the researchers, but they're not really hand in hand with the, they're not really tied in with the experimental end of it. So you need to run through and see, does it still meet that 80% qualification? And so that's the approach that we've been taking. It's required statistical sampling in a lot of cases where there are 40 or more, or if there's 40 or more projects. And again, some of our clients have literally thousands of projects that we're sampling on. It's not realistic to go through and determine QREs for each of those. So coming up with the best method we can for determining QREs with the projects that we talk about and talk through. And then, determining what the end result is, how that extrapolates out based on the statistical sampling approach that we're taking. So the good thing about this, actually, let's start with the bad thing about this. It takes a lot more time. It's a lot more cumbersome. It is, I've talked to a lot of clients that are like, what happened? How do we get here? We were here this year. We're here. What has changed? But then when we explain it, you kind of see the realization, you see the understanding of, okay, yeah, that does make sense. Let's make this more defensible. Now, the good thing about it is that in a handful of cases, maybe more than a handful, we found out that our clients have better records than we thought. Once you start prodding and saying, hey, we can't go with that top-down approach anymore, you're forcing the discussion of saying, what else is there? And we found some really good methods of accurately determining and documenting those hours on a project-by-project basis. That's been good. The other good byproduct of this is that this is going to answer all of those new Form 67, 65 questions, just as a byproduct of the new process. So while that's more cumbersome, we feel like we're well suited to address it. So that's been the new way that we've been approaching it. I guarantee you there's a client or 2 out there that have a little Phil Williams voodoo doll that they're stabbing occasionally because of the additional questions, the additional time that it's taking. But the good news is once we get to that process once, it's going to become more replicable. And that's where we're hoping to be by next year once everybody has gone through it. So that's my chicken little spiel. Hopefully everybody was able to get something out of that, but that's really what we're looking at when it comes to that new process.
All right. Well, that was a lot to digest. But that's why I wanted to go this early on, even before we got to 174, because this is, and just as my own 2 cents here, there's been many clients that we've talked to in the past, or we've been referred to by a tax professional, where the client's been doing it themselves. This is going to be very hard for them to meet the requirements with the way they've been doing it, because they've probably been doing that top-down approach and probably have no clue how to do the bottom-up approach. And honestly, there's some tax professionals that have taken credits for clients as well, which is completely fine. And a lot of them, it's a smaller credit. It's just going to be very tough for that to continue this way, in my mind, because of the documentation and time requirements that are going to be involved. So it's that we just want to let you know what's going on. This is precedence. IRS has been fighting this very hard the last few years, and they seem to have something in place now that they really wanted, which I'm not sure why, in my own opinion. R&D R&D tax credit should be something to stimulate the economy. And I know there was some probably credits that were being claimed that shouldn't have been claimed, and that's what they're trying to get rid of. But unfortunately, with all of this, has to happen, but with all of this, they're going to have some smaller clients just not claim anymore because they just can't meet these requirements. And that's the drawback. Maybe in this new 67, 65, there'll be some de minimis rules that apply to the documentation requirements as well. Who knows what happens? But that's potentially the outcome is it's going to hurt small businesses as much as anything. All right. All right. Well, Phil, stick around for the 174 discussion. I'm going to go through this fairly quick. We're already at 50 minutes. And so we already kind of defined what a 174 expense is. It's all costs associated with research and experimentation. R&D tax credit is for cost. This is all big package of costs. And so when we're looking at 174, it is not, the $1 million we calculate for the 41 credit. It's going to be a lot of additional. We have to worry about this, obviously, because of what happened in the Tax Cut and Jobs Act. Back to 1954, when this was defined, we could expense R&D expenses as incurred simply by doing it the first year. So we never had to worry about identifying a 174 expense because we didn't have to worry. We just expensed them. Tax Cut and Jobs Act changed all that, which you all know. That kicked in the year 2022 was the first year we had to deal with this. Any U.S.-based domestic expenditures have to be capitalized, amortized over 60 months. Any international expenditures are capitalized and amortized over 180 months. We've been waiting for guidance from the IRS to tell us what a 174 expense is. We have gotten 4 different things associated, or 5 different things associated with it. 3 of them are Rev Procs that came out that talks about a change in accounting method when we're adopting these new changes. I'm not going to highlight those at all right now. We did get some guidance to come out in IRS Notice 23-63 and 24-12, which is talking about what 174 expenses are in general. Before I even get to that, just real quick, because I get this question a lot. Hey, is my credit only based on the amortized cost in an individual year right now because of this? No. When the Tax Cut and Jobs Act defined these changes, they had a conforming amendment that basically said you still get to take the cost that you paid for incurred during the tax year in the calculation of the credit, not the amortized cost. Separate when we're calculating the credit. That was a big deal. That was good. In addition, this is a really big deal. There was another amendment that was put in there, and this amendment, was talking about how do we deal with 280C? And 280C is, do we reduce the credit by a certain percentage, or do we reduce expenses by the amount of the credit to get to the value of the credit? Which, under recent laws, the value of the credit was 71% for the most, or 79% for the most part. It was reduced by the corporate tax rate of 21%. So you have a $100,000 credit. You would take a $79,000 credit, or you had the option of reducing your expenses by the amount of the credit, substantially doing the same thing. Although pass-throughs, you need to look at that because it'll change. And just so you know, poll up, last poll, I'm pretty sure this is the last one. Make sure you go to that poll. What happened in this amendment they made in the Tax Cut and Jobs Act is they said, well, you only have to adjust expenses if the current year amortization exceeds the amount of the credit, something sort of like that. And that almost will never happen. And so what they did, in my mind, probably accidentally, I don't think this is the intent, but this is what they did, is they basically said you no longer have to take a reduced credit. You no longer have to adjust your expenses for the amount of the credit. If you have a $100,000 credit, now the credit's worth $100,000. That's what happened in this. Whether it was intentional or not, it is out there. And IRS has identified that. IRS has addressed it. They know it's out there. They don't like it. This is my opinion. But at this point, there's nothing that they can do about it going forward. And Phil, you can confirm or deny this. We haven't just taken the full credit, ignoring a reduction of credit or a reduction of expenses, correct?
Yeah, I think it's probably been a 50-50 split. We've been explaining it to the CPAs and letting them make the call. I think there's a really strong argument for including the full credit and not adding back, though.
Okay, so that was again, probably unintentional benefit, but it is a nice benefit out there. Now let's dig into the little bit. You know what? Before I even get to this, you're all probably wondering what's going on legislatively, and I don't want to miss that because we only got a few minutes left. So legislatively right now, you all heard about the Tax Relief for American Families and Workers Act that passed, almost unanimously in the House back in January or February, whenever the date was. I think it was the end of January. And then went to the Senate and died. and it's been sitting there, and nothing's happening. Nothing's happening because the ranking member of the House of the Republican Party, the Senate Republican Party, doesn't want this bill to be brought to the floor because he has this grandiose idea that he'll be able to come up with this huge overreaching bill, after these next elections. And that's the impression that I get, at least, or that we're hearing. Could this bill still come in front of the Senate? There's a chance. There is strong effort by a lot of people in Congress to get this moving. Rumors are that there's a handful of Republicans that are willing to vote yes to this and not follow the ranking member of the Senate. They need another handful more before they can guarantee that would happen. Are we going to count on that? In my opinion, no. I don't think it's going to happen at this point. I don't know, Phil, if you've got any more update since that I just said.
No, pretty much everything I've heard is in line with what you said.
Okay, so right now, just go under the assumption that this isn't going to happen. If it does, we'll all be surprised. And so, even though we thought that would happen, we thought it'd be great, we think it'll be great, who knows what the next iteration of a bill is going to be. We'll have to wait and see. And there's things being proposed out there as well right now, but not time for that. So let's just talk 174 in the next 2 minutes that we have. This guidance came out the end of last year. It basically defined what 174 is. There's a couple things that I wanna highlight here. Basically, how do we allocate indirect expenses to 174? And IRS basically said, well, one thing before I even say that, this is a big deal. When we were talking about employees' time involved in 174, and the original definition said all cost incident to a research and development project. In this guidance that came out and said general and administrative services departments that only indirectly support, and they have a new definition, specified research expenses instead of qualified research expenses. Only indirectly support, like HR, legal, and finance, those are not have to be included in 174. That was a big deal because we didn't know. This was big guidance. So some of this guidance that came out in 174 was a pretty nice deal. And I'm skipping through a lot of these. You have the slides, or you will have the slides, so you can look back at them. The one big thing is how do we allocate depreciation or other costs associated with R&D that we can't individually identify the amount of time or space or that. And what they said is just figure out a method to allocate these additional expenses to 174 that you do on a consistent basis. You have flexibility. You can do it for different types of expenses. For a project cost, maybe you do it based on hours. We're identifying hours that are R&D and hours that aren't R&D, and so let's figure out that allocation method, and we'll use that to allocate certain expenses to 174. Or if it's a facility, maybe it's on square footage. We do R&D in this 10% of this building, and so now 10% of the cost allocated. So bottom line, in this guidance, they said, hey, we're giving you flexibility, but be consistent on how you do it year to year and show us the methodology you're using. Make it make sense. You maybe could use hours to allocate facilities, but it probably makes more sense to use space allocation to allocate facilities. But if you could make it make sense, you have the flexibility to do it. Just be consistent year to year. That was a big deal. And then in software development, we were concerned with they're saying everything associated with software is R&D. Basically, that's what it sounded like at the beginning. And they pulled back on this with this guidance as well. One of the new terms that they came out with in this guidance that came out was upgrades and enhancements. So if we're doing something to a software and it's adding additional functionality, or it's materially increasing the speed or efficiency of that software, that's an upgrade or enhancement that you need to look for to include in 174. If it's simply installing the software or that kind of thing, they're saying that that's not something we need to be aware of. So software was a big thing that they looked at in this as well. And then what happens if we dispose of an R&D project that we've capitalized? How do we handle that? Well, if the business continues to exist, you sold it to someone else or whatnot, that sticks with the business and you keep amortizing it. If basically everything, I mean, if the business existed, yes. If the business completely ceased to exist at that point in time, you could write them all off. So it gave us some guidance on that. Not going to go deep into that because we're running out of time. I'm not going to go into an R&D example, but you have it in there. When you look at this, the biggest thing I wanted to show you was, there's a lot of direct employees involved in R&D, not necessarily. And we talked about CEO and being able to prove the amount of time they spent, not just a general, but we have to do this on a case by case or a project by project basis. But just be aware that there are significant employees. I mean, I know we were talking about all these things that make it harder, but there's still significant benefits for there, and there's still significant amount of time spent on R&D. So that was it. That was the gist of this was, yes, things have changed. Things have significantly changed. They've changed from a documentation standpoint. They've changed from what we have to send on the 64, 67, 65, and how we have to, even deeper documentation that we're even putting on the form at this point, but that's a good starting point. They've changed from what a 174 is, but this guidance has got it a little bit easier, a little less strict than we originally thought it might be the case. And the future of 174 is still up in the air, and I think we're as up in the air as we've ever been. And so just be aware, we're under the rules of capitalization at this point. We can't do anything about it. That's the presentation for today. I appreciate everybody being here. Any final thoughts from you, Phil?
No, we covered quite a bit.
Yeah, we did. That was a lot, but that was I hope people got a lot of good information out of that, because you need to be aware of this, because this is, you go to an audit with the IRS and you don't have this in place, it's an automatic, sorry, you're gone, no credit here. And so just be aware, be prepared, and reach us to us anytime if you have questions on any of this. And thanks again. Thanks everybody for being here today.